On page 25, we're looking at a few ratios which help us do financial statement analysis. The first set of ratios that we're looking at is put a box around liquidity ratios. Now these are measure of the company's short-term ability to pay its obligations as they come due. So we're looking at working capital, which is current assets minus current liabilities. Current ratio, which is current assets by current liabilities. Quick or asset test ratio, that's a more stringent current ratio, where on the numerator we exclude inventory and prepaids. So we left with cash, marketable securities and receivables. The denominator remains as current liabilities. Then you have current cash debt coverage ratio. We're looking at net cash provided by operating activities divided by the average current liabilities. The next set of ratios, put a box around activity ratios. So how effectively is the entity using its asset? So when you're looking at receivables turnover, we're talking about how soon is the entity able to turn over its receivables. Turnover ratio means we're going to turn it over. So when you're looking at receivables turnover, the denominator is average receivables. Numerator, that's net sales. Inventory turnover, denominator is average inventory. Numerator, COGS. Asset turnover, denominator is average assets. Numerator, net sales. Then you also have number of days supply in average inventory, number of days sales in average receivables. So number of days supply in average inventory, that's 360 divided by inventory turnover ratio. Number of days sales in average receivables, that's 360 divided by receivables turnover. Now guys, I know you sound pretty familiar to all these ratios because we've already covered liquidity and activity ratios back in FAR-2. So draw a bracket on the left and write FAR-2. If you don't remember these here, go back, revise, and I'm sure you're going to knock it off. Next, put a box around profitability ratios. Now these ratios measure the degree of success of an entity. So when you're talking about profit margin, we're looking at net income by net sales. Rate of return on assets, we're looking at net income divided by average total assets. Return on equity, the numerator is net income minus preferred dividends. That's what goes to the common stockholders, divided by the average common stockholders' equity. Then we've got earnings per share. We looked at it in FAR-5. So that is net income minus preferred dividends divided by weighted average common stock outstanding. Price earnings ratio. So guys, as the name signifies, the numerator is price, so the market price. The denominator is earnings, earnings per share. Payout ratio, how much dividends have been given out. So that's cash dividends divided by net income. Next, put a box around coverage ratios. Now these are measures of the degree of protection for your long-term creditors and investors. Debt to equity ratio, that's debt by equity. Debt to asset ratio, that's debt by assets. Times interest earned, numerator is the income before interest expense and taxes and the denominator is interest expense. Cash debt coverage ratio. So the numerator is the net cash provided by operating activities and the denominator is average total liabilities. Book value per share, we looked at it in FAR-5. So that's common stockholders' equity divided by outstanding shares. Now I want you to put a bracket around profitability and coverage ratios. And we're going to cover these in detail when we were doing BEC. So right there, cover in BEC.